Hi, everybody. Hope you are well. Welcome to today's webinar, How to Legally Reduce Your Tax in 2020. I can see a lot of people popping in now. Hi, Kim. Hi, Matthew. Hi, Michelle, Moses, Thomas. So I can see a lot of you that coming in. So um, can you all hear me okay? If you can you please say hello or say yes? So I want to make sure that you can hear me okay, please. Let me just put that one in up here. Say hello to me so I know that you are, yes, okay, fantastic. Okay, that's great. Okay, you can all hear me. That's good then. Well, okay, I'm just gonna wait for one more minute. How's everybody? Good? Well, tax time is coming. As you can see, 2020 tax time is coming. And I'd like to welcome you all to this webinar. I'm supposed to do it every week, but for the last few weeks, we were so busy helping you guys claiming money from the government. A lot of free cash from the government, which is great. I mean, I hope you're happy and it helps with your business. Yeah, so now that's all. The JobKeeper payment still going, but today I want to share with you is very important thing is like today is the 11th of June. We only have like less than 18 days to the 30th of June. So I want to share with you how you can reduce your tax in this 2020 because it's very important to have more money in your pocket, in your bank account. And so then you can use the money to do whatever that you want. So let me ask you a question while you're here. Like, do you want to give your hard-earned money to the tax office, to ATO? Say yes if you want to give your hard-earned money to the tax office, or say no. Okay, good. No, no, no. Okay, that's good. And do you want to reduce your tax for this 2020 financial year? What's the answer? Yes or no? Yes. Okay, great. Okay, I can see a lot of yes here. So you are at the right, I mean, you are in the right place at the right time. And today I'm going to share with you the magic of tax planning. And I'm going to share with you some tax planning strategies as well. So let's imagine that you have, just going to go to the next slide. I'm going to move this on a bit. Just 1 second, blocking my wheel. Okay, so imagine like what you could do with your tax that you save. Like, you know, when you have more money that comes back to you or tax refund, you can use that money to pay off your home loan, pay off your credit cards. I'm sure, you know, a lot of us maybe have a bit of debts to pay off. Having a family holiday, well, maybe just in Australia at the moment. And you can also have the money to top up your superannuation, which is, you know, for your retirement. Or maybe you're thinking deposit for another investment property, or pay your children's education, or maybe upgrade your car. So there's a lot of things that you can do once you can have, you know, the tax saving and you have more money in your bank account. Then there's a lot of things that you can do, right? So I'm sure you all want that, right? Okay, I can see the yes here. Okay, that's good. Now, for those that don't know me, like, because what happened is that I put this webinar presentation on Facebook Live. So maybe some people that watching now probably don't know who I am, like who am I? My name is Eng Siviang, and I'm the founder or managing partner of TMS Tax Accounting and Financial Services. I am a Fellows of Certified Practicing Accountant and also Fellows of Self-Managed Super Fund Specialist. I have been in this industry for a long, long time, since 1985. And my special area is to helping people like you know, moms and dad, individual, helping you to structure well, protect your assets, structuring saving tax, build up, helping you to build up your wealth. So I also specializing in self-managed super fund. That's my special area. Okay, that's all about me. Now, I want to stress, like, what I'm sharing you today is more like a genuine information only. I don't want you to sort of listen and then you just go and act, because you need to talk to us to see if it's actually suitable for you. Some of the tax planning strategies that I'll be sharing with you might not might not suitable for you. So you have to be careful. So I just want to stress that this presentation is not a financial product advice, and it's only intended to provide genuine information only. So it does not take into account your individual objectives or your financial situations or needs. And the information is taken from the source, which I believe to be accurate. But TMS accept no liabilities of any kind of any person that using these strategies and just go and act from it, because you need a personalized advice to see if it's actually suitable for you. Okay, so that's my disclaimer. Okay, you look at this and you go, what is this? Well, basically, to reduce your tax, it's like a numbers game. It's like a game, and to be able to reduce your tax, like to win this game, is you need to understand the law, the rules, and the legislations. And you can't break the rule, because if you break the rule, you're going to be in big trouble with the tax office, because the ATO will prosecute you, they might fine you, they will penalize you. So it's very serious. Like, you can go to imprisonment as well. So it's very important that you know how to play this tax game. Okay. And another thing is that I want to stress is, like, it is criminal if offend that if you don't lodge your tax return or you fail to meet your tax obligation. So it is very important that you need to get it right. Even though, okay, we want to reduce our tax and nobody wants to pay more than what they're supposed to pay. But at the end of the day, you have to follow the rule, follow the law, follow the legislation, okay? I just want to share with you the ATO also have this, let me just copy. Oh, I can't get in to the link. Okay, never mind. But if you go into the ATO website, they also say that you have tax planning. It's legal. It's like you're allowed to legally reduce your tax, and you have the right to arrange your financial affairs to keep your tax to a minimum. And this is referred to as a tax planning. Or tax effective investing. So tax planning is legitimate if you have to do it right. But if you enter into some sort of tax avoidance scheme, then that's illegal. Okay. So what I'm sharing with you today, it's all legally things that you can do. Things that you can apply to yourself. Now, let me just explain to you about this income tax formula. I know it looks like a bit complicated, but it is not. If you understand this deeply, then you know how you can reduce your tax. So basically, to work it out, your tax payable is like, you have your income, which is what we call assessable income. And then you take away your deduction, your tax deduction. That means that it's not everything is deductible, but there's certain thing that you can allow to deduct. So the income minus deduction is equal to your taxable income, right? So if you want to reduce tax, then the main thing is that you either, for the income, I don't want you to go and reduce it. I want you to make as much as you can. But because now it's to the end of June, if you can defer your income, certain income, then you defer it, because you don't want to add too much more into this financial year if your income is already high. And for the tax deduction is that you want to maximize it. You want to claim as much expense that you're allowed to claim in this financial year. And I'm going to be showing you what makes a big difference if you can maximize your tax deduction to your taxable income. Okay. Then when you get your taxable income, then you times by the appropriate tax rate. So the tax rate in this country, it starts from you know, 0, 15%, 21%, 34%, 42%, 47%. The highest is 47%. So whatever that you do, you're trying to minimize this tax rate as well. You don't want to pay the maximum 47% tax rate, because 47 means like, if you make $100, you have to give $47 to the government, and then you only have $53 in your pocket, in your bank account, which is, you can't do much, and you can't use that money to even, you know, pay for your sort of like a normal living life expense and all that. So if you understand this formula, then you know the ways to reduce your tax. Okay, it's got, and how to play around with this tax rate is depending on the structures that you investing your assets on. Like a lot of people just invest their properties or shares in their individual name, but it's not a good idea, because one is like the individual can pay the tax up to 47%. Whereas if you have a trust, then you can maybe split the income, or maybe you got money in the super, like if you invest in super, it's only 15%. So you play around with this tax rate, it's by using the right structure to hold that assets, okay? And then taxable income times by the tax rate, it's equal to tax payable. So now we come up with the tax that you have to pay. Then you have to plus your Medicare levy, and you take away your offset, the offset that is available from what the government can give it to you, and then you equal tax assess. And then that's the amount that you're supposed to pay. And then you take away the credit. That means like during the year, you might pay the PAYG withholding, you might pay PAYG installment, or maybe you have franking credit. You take away that, then it becomes either tax payable or tax refundable. So the game of tax is for you, it's, if you understand this income tax formula really well, any point of then you just do a bit here, a bit there, a bit here, a bit there. The result of this is just amazing. And I'm just going to show you to prove that, and you're going to see it by yourself, okay? Have you got any questions about this? Did I explain it clear enough, or is that very complicated for you? Because I'm trying to make it very simple. I know you're not an accountant. I know you're not a tax agent. That's why you engage us to help you to do your tax return. But I really want you to have this knowledge, okay? And then when you understand it, it's going to be very, very helpful for you. Okay, fantastic. It's very clear. Okay, thank you. Now, move on. So tax planning is basically, the key is to try to reduce your tax. And how do we reduce your tax? Is using different strategies, all sort of different strategies to try to reduce your tax legally, okay? And once you know how much tax you have to pay, things like that, then it's planning how you can pay that money. So the tax planning, it's also very important that you have to have this in mind. Like a lot of people misunderstand about tax planning. It's like, I don't mean like for you to just go and spend the money and to get the tax deduction. If you spend the money, it's not going to help you to increase your wealth or building up your wealth or increase your assets, then don't do it. You rather just pay the tax, okay? You only want to get the tax deductions or reducing your tax. It's because if you can, for example, you got the extra money to buy, to investing in property or in shares. In return, you also can reduce your tax, because in a way you reduce your tax, you also increase your wealth. So you always have that goal in mind. It's like, you don't go into spending money just to get the tax deduct, to pay less tax, because that's wrong. If you have to put that as your second priority. The first priority is that, will I make more money from doing this activity? Will I make more money of doing this? Will this going to increase my business, or it's going to increase my wealth, my business? Then you do it. Do you understand what I mean? So don't just go and save tax, and then instead of save tax, you're actually losing more. Because at the end of the day, if you spend $100, what you can get is, if your tax rate is 39%, you only get $39 back, you still have to spend that $61. And that $61, if you spend on something is not necessary, then you're wasting your money. So it's not a smart way of doing it. So tax planning helps you save tax, and it has to leave more money in your hand. And a good tax planning strategy is to tailor to your goals. So you need to have a goal first. You have to know what you want, and then you refine the strategies to be able to achieve that goal, also at the same time reducing your tax. Okay, that's very important, and I want you to keep that in mind. Now, there's 3 steps to legally reduce your tax. Okay, now you can ask me question as I doing it, and then if anything not clear, then let me know. Okay, step number 1 is you have to understand your current financial positions. That means like, I know we only up to 11th of June now, and you probably think, I don't know how much income I'm going to earn up to 30th of June. But because it's only a few weeks left, you can estimate. You know your income so far up to 11th of June. We'll only have a few days to estimate. So you need to be able to estimate your business profit, or you estimate your personal income. And we need that figure to be able to do tax planning. And we'll do it up to the 30th of June. And then after we got that, then we have to work it out. Okay, based on my current situation now, based on the income that I earn now, or the salary that I get now, how much tax am I supposed to pay? Like before I'm doing anything, before I'm doing any tax planning. And if you're looking at that and say, wow, I have to pay 70,000 or 100,000 in tax, then you have to do something, because once the money that you pay to the tax office, once it's gone, it's gone. You can never get it back again. And it's your hard-earned money. And you want to be able to keep it as much as you can, so you can use that money to increase your wealth, or to, to spend on your lifestyle. Okay, so that's the first step. You need to get that. And then the second step is like, okay, you're looking at, oh, I have to pay tax about 70,000. What am I going to do to be able to reduce this? Then we're going to develop some tax planning strategies in order to reduce your tax. But like what I say to you, it's like, you don't just want to reduce the tax and then you cannot achieve your goal. You have to try to think about your goal first, and then think about the tax next. Okay, and once you work out the right planning strategies, that how you can use that strategy to reduce your tax, also at the same time to grow your wealth, then you say, okay, this is going to work. Then you have to take action, and you have to implement that tax saving strategy before 30th of June in order to reduce your tax. So there's 3-step process here. Is 1, you have to understand where you are now. 2 is like, okay, if I'm going to do that, how I'm going to do it, and by using the tax planning strategy. I got to, yes. So yes, that's right. So we have a lot of people have done this. Is like they just go and spend the money on unnecessary things just because they want to save tax, but it's not going to do them any good with their wealth or with their asset. Then it's not a smart way. So I want you to stop doing that. Okay, don't do it. I'd rather you just go and pay the tax using the right structure to pay, like, let's say 27.5% tax. It's better than you just spend the money for nothing. Now, I'm not going to go through this today, but I just want to show it to you that there's so many tax planning strategies that we can use. Okay, in here, I list out about 82 tax planning strategy, but if I mix and match, like, put this one with that one, it's actually more than 82. It's actually more than 100, 300. That I just list here is the things that we as a tax expert, we know how to use it for you. It's just like going see the doctor. Like, we have so many different medicines, but it doesn't mean like I'm going to give you all the medicine, otherwise you're going to die, right? We have to look at like what exactly that you need, what is your goal, and what suits you. Then we're using that to help you. Okay, so there's a lot of tax planning strategies that we can use. Now, instead of talking about all this theory, and I don't want you to fall asleep, I'm going to give you a real case study, but I changed the name and I changed, I'll sort of make it easy, change the amount. But this is a very typical moms and dad that came to us to get the tax planning done, okay? So I just give you a case study here. It's like, we have John and Jenny. They own a commercial cleaning service business, and they're operating using a trust, which is a really good structure. And if you don't have that, you should talk to us and then see how we can arrange that for you, and to see if it's actually suitable for you or not, first of all. So we call it J&J Family Trust. And we estimate the net in business profit is about 250,000, okay? And the goal is that they want to save tax, and they want to have more money to pay off their debts and their credit cards, and also to top up the super, because they're close to like a retirement, and they want to build up their super, because super is for their retirement. And after they're 60, they draw the pension out, then they don't have to pay the tax. So which is really good strategy that they should have. It's very important. And they also, for the business, is like the cleaning business is, especially in this COVID-19, is actually booming, because they have more contracts and they have more job. So they want to get new equipments and to help them to do the job. And it's going to cost them 60,000 to get this new cleaning equipment. And also they need a second-hand van, which is about 30,000. So they got some money in the bank. They got approval from the bank. Okay, so this is the situation. Just make it very simple for you, and I want to show you how we can help them. Okay, so first of all, like what I just explained to you, step number one is to understand what business profit you have so far, or your personal income. It works out to be similar, and we have a really good strategy that how we can work out the best tax saving for you in your depending on your goals. Okay, so for this case, 250,000 is the estimate profit in J&J Family Trust, because as a trust, you don't want to hold the income inside the trust, because the trust will have to pay tax about 47%. And that's why if you have a trust, then it's very important that you need to do a trust distribution resolution before the 30th of June. And I'll talk to you some action that you need to take if you have a trust, and which is what we are doing now. Is like we're sending out the email to all you guys that owns the trust to explain to you that it's very important that you need to have this distribution resolution signed before 30th of June. And if you don't do that, and if there's an income set in your trust, then you're going to pay 47% tax, which is a lot. So imagine if you've got 250,000 sit in the trust and you haven't distribute out, 47% is that how much tax you have to pay? Nearly half of it, right? So it's a lot of tax, like 125,000 or something. So in this case, we say we're going to distribute to John 125 and to Jenny 125. If we just do that, we just distribute this money to John and Jenny, then the tax they have to pay is 75,558, which is a lot of tax, right? And then John and Jenny might say, oh, Eng, I think it's a lot for us to pay. Can you help us to, what can we do to reduce this? And then I mean, that's step number two is now, okay, of course we can help you. So we're going to apply some tax planning strategies to help you, right? So the second step is I just put like number 67. It's out of that, you know, that 82 tax planning strategy that I show you. It's number 67. That's what we're going to pull out. Is like, okay, because one of the goals they want to have is that they want to top up the super, they want to build up their retirement fund, they want to be, when they retire, they want to have money in their retirement, in their superannuation fund. So super contribution is suitable for them. And the maximum that they can contribute this year is 25,000 each. So let's do that. Let's give them 25,000 each, right? They're going to contribute 25,000 each to their super fund. And on top of that, I say to them that they don't have a self-managed super fund yet. And maybe it's because they like to be in control, like because they want to control their own money, and they want to be able to invest in things like, for example, they want to be able to manage the money themselves. They want to be able to maybe investing in shares, maybe, you know, maybe they can investing in property. Like they want to want to manage their own superannuation fund, and they want to have that option, that choice, that they can invest in, you know, land or whatever that they want. So then, okay, so because that's what they want, and because they've been running a business for a while, and I know that they have that ability to manage their own money, then maybe the self-managed super fund is suitable for them. Then we say, okay, let's set up a self-managed super fund. So we put the 50,000 that they contribute into the self-managed super fund. So they can still invest that 50,000 into, they can buy shares, they can invest, they can grow that money more. So they're building up their retirement fund, right? But when they put the money into the super fund, of course they have to pay tax. So the tax on the super fund, it's 15%. I mean, it doesn't matter if you put the money in your own self-managed super fund or in the retail fund, you still have to pay the 15% on your concessional contribution. It's just the law. So, but in this case, they choose the vehicle, they choose the place to put the money is their own self-managed super fund, but they still have to pay tax. So the tax on that is 7,500. But even though you add it all up, okay, let's see how we do it. The tax before, it was 75,558. Now it's reduced to 60,934. So straight away, the saving tax of 14,624. So which is a lot of money, right? 14,624. And this is only for the first year. Imagine if they do that for, I don't know how many years that be until they retire. It's going to be a lot of money. So this is what I mean by smart strategy. Is like you're saving your tax, but you're also growing your retirement fund as well. So it's a win-win, right? But it's just gonna get better than that. Like then they say, oh wow, that sounds really good. Okay, we want to do that because that will help us to grow our retirement fund. We also can save a lot of tax. Then another thing was that that we apply is okay, so this is the summary. So basically I want to show you, okay, I'll show you at the end the tax planning report that we give you. If you comes to us to do tax planning, we are not just working out the number, we also give you a report, and the report will show a really clear calculations and also the step that you need to take, and the explanation why we recommend the strategies and so forth. Is a beautiful tax planning report that we will give it to you. So in this case, if they just do that, they already save tax of 14,624, which is really, really good, right? Don't you think? Don't you guys agree? No? No comment? Do you like that? Talk to me. Okay. All right. Yeah, 100%. Thank you. Okay. Thank you for your interaction. So the next thing is like, remember I told you that they wants to get the equipment, and which is cost 60,000, and then they also want to get a secondhand van, because those assets, if they get it, it's going to help them with their business, because that means that they can do their work faster, they can make more money, they can get more contract, they can build up more business income. So to pay for those, to pay for new equipment or new van, it's going to help them. But one of the good thing about this year is like, because of the COVID-19, the government announced that about this instant assets write-off. If you purchase any single item for 150,000 or less, you can write that off straight away. And I mean, at first they only extended to 30th of June, but it's only a few days ago, I think it was only about 2 days ago, they announced that now it's up to 31st of December 2020, which is even good news. So if you purchase anything even after this financial year, you can still eligible to write that off. And let me show you why this is so good. Because the John and Jenny, they say, I don't have cash to pay for 60,000 for equipment or 30,000 for the car, but I got money from the bank. I borrow the money from the bank. So what they can do, they can borrow the money from the bank, and they can purchase all these items first and get a tax deduction, and they can pay it off slowly to the bank. And the interest they pay on those loans is also tax deduction as well. So it's really, really good strategy, right? So if they do that, right? If they do that, then if they spend 90,000, which is from the loan money, not from, I know they don't have the cash flow to pay for that, but they can borrow, they can go into high purchase or check to mortgage or borrow the money from the bank, like those unsecured loan. And if they pay for these equipments or this van, they pay 90,000, but they got tax saving of 18,900 straight away, which is really good. So let's see the bottom line, okay? If I put that into our formula, our income tax formula, what that means is like the taxable income reduced. Furthermore, and you look at the comparison, like before was 75,558. Now they only need to pay, including the super, 26,034 cents. Oh, sorry, $26,034. Not cents. So all up, how much tax saving they make? 49,524. Is this a lot of money or not? This is a lot of money, right? And then what they can do with that money for 49,524, they have the choice. They can either put the money back to the business as a capital to grow the business, or they can top it up in their super for the next year, or maybe they can buy another car, or maybe they can pay off whatever the credit debts that they have, like they the credit cards and all that, which is charged very high interest. They can do a lot of stuff with this money, which is this is a really important, because once, if you don't do any planning and you just go and pay the tax, then you're not going to get any, like, and then you come to us after 30th of June, you say, wow, and you're going to say, wow, I have to pay 75,558, and you say, what can we do now? You might come to us like in January 2021 to do your tax, and I say, sorry, it's too late, because you're in January 2021 now. What can we do before 30th of June 2020? It's just too far away. We can't do anything. It's too late. But if you do something now, you can have these benefits. That's why I say it's so important to do tax planning. It's so important. Can you see the benefits I'm telling you here? I'll get excited. So the estimate tax position for John and Jenny now is like they save 49,524. I mean, let me ask you a question. What would you do with that money? What would you do? Share with me. What would you do with that money if you have like nearly 50,000 back to you that you don't have to pay to the tax office, and which is legit, which is legal? What would you do? Go on holiday? Yeah. Okay. What else? Oh, holiday where? Overseas or local? You have to be careful, okay? The COVID-19 is not over yet. Yeah, so you can do a lot of things. So it's really, really good. Now, okay, I'm going to share with you another strategy, which is really cool as well, but I'm still using sort of similar case, right? Similar number. By using this, I put strategy number 1 here, which is on my list, is number 1. It's using a bucket company. And they say, what is a bucket company? Well, if you have a trust, then after, let's say you distribute to John, distribute to Jenny, put some money in super, get some equipment, but you still want to, your tax rate is still about 30%. And you say, I don't want to pay more than 30%. What can I do? Then you can incorporate this, you can set up this bucket company to become a beneficiary of the trust to receive this money. And the bucket company, when they receive this money, they have to pay the tax of 30%. But the good thing about the company is about franking credit, because the money that the company pay, it's just gonna sit at the franking credit. And that means like later on, when your income start to be low, you can get this company to pay you out the dividend, and you get the franking credit back. I'm not going to go into that complicate, okay? But there's a lot of things. And you can also make this company as your finance company. Like instead of you have to borrow money from the bank, you can borrow from your own company as well, like your own finance company, but you kept your tax rate at 30%. And there's a lot of benefits of having this. So if your trust generate profit, then you better talk to me, okay? You talk to us, and then I have lots of strategies to help you. So just to make it so that you can understand. If I put it in number, it's like, okay, before the planning, you have to pay tax 75,000. And let's say you say, I'm not going to put the money in super. I'm not going to buy any equipment. I'm not going to buy, what can I do? 75,000. Then what I would suggest, okay, maybe we set up a bucket company. I mean, even if we set up a bucket company and we distribute, let's say 90,000, or we can be less. Okay. You can play around with the number depending on the tax that you want to pay. We can work that out for you. And let's say in this example, I just don't want you to be too exciting. That's all. Let's say I split it this way, like 90, 90 and 70, the tax rate is already dropped down to $64,034. That means like by just doing this strategy, you already can save $11,524 in tax. This is really, really cool, right? So what I'm trying to explain to you is like, there's a lot of tax planning strategies that you can use to help you to reduce your tax legally. Have you got any questions that you want to ask me, or am I too excited? Okay, can't see any question coming in. Okay, let's move on. So the value of this strategy is $11,524 in tax that you save. Okay, tax planning strategies. Like what I said before, like everyone wants to reduce their tax payable, and we are here to help you. We're here to help you to do this, okay? And there are 82 or more tax saving strategies that is available that we can use, depending on your goals. I need to stress, and again, it's like not every strategy lists up on those lists are suitable for you. You need to consult with us to find out what might work for you and how it works, okay? The tax planning recommendation is generally involved with spending money on something, which is create your tax deduction. What I mean is like, okay, put the money in super, that's also involved with spending money, buying equipment or spending more money. But at the end of the day, there's something that you spend your money on, could be an expense or an asset or an investment related payment. So what I mean is that if you spend that money, and let's say you spend the money to get the equipment, that's going to be your assets. If you spend the money and you put it into superannuation, it's going to be your retirement saving. So you have to be careful. It's like, okay, I'm going to spend the money to get tax deduction, but what is that money that I spend? It's going to give me. If it's going to increase my assets, it's going to increase my wealth, it's going to build up my wealth, then yes, that's a good strategy. But if I'm spending money and I'll get nothing back, and all I'm losing is losing money, like some people say, oh, I go for negative gearing property and I just want to get tax deduction and I just want to get tax. That's not a very smart way, because if you know the property is not going to grow and it's really highly negative gear and just put you into so much cash flow problem that you have to keep paying interest and nobody renting that place, and that place is crap and it's not growing, then why are you spending money on that? Like, it's you'd rather just pay the tax. Let me drink some water, okay? Get so excited, sorry. So that's what I mean, like, yeah, I understand. So I got a comment here to say that what works for John and Jenny may not work for us. So must be, yeah, exactly. Must be personalized. Like, that's what I say at the beginning, is whatever I share with you today is just for genuine information only. But the main thing that I want to get through this message is like, just to show you the power of how you can use the tax planning strategies to save tax. But of course, whatever that I show here, it might not suitable for you. So don't go and just do it, okay? I just give you as an example only. Okay, the other thing is like, I say here is like, please don't fall into a common trap of spending money just to get a tax deduction. because you only save tax based on the marginal tax rate proportion on the amount you spend, not the full amount that you spend. Because this one, I stress again and again, is people misunderstood. Because let's say you earn 90,000 and your marginal tax rate is 39%, right? And let's say if you spend $100 on the tax deduction thing, that will only give you $39 back. You still spend that $61 to get that tax deduction. So you want to make sure that $61 that you put in, it's going to give you the benefits back as well. Like it's going to increase your assets or increase your wealth. So like a lot of people say, oh, but it's tax deduction. It's tax deduction. If I go and get the property and I'm highly negative gear and I'm making huge loss, 20, 30,000 losses in a year, I'm going to get tax deduction. But the property might not be good, might not grow. It's just going to put you back to the like even worse situation, if you know what I mean. Like if the assets is no good, then don't do it. Don't do it because of the tax. It's stupid. I'd rather you just go and pay the tax of 39% and you still keep the $61 rather than you losing the whole, you know, $61, right? You get the $39 back and you're still losing $61. You rather just pay you rather just losing the $39 and keep the $61, if you know what I mean. Do you understand this? You really have to understand this because a lot of people misunderstood this part. And I have to convince them, don't do it. You know, just because you want to get the $39 back and you're losing the $61. It's stupid. So tax planning is actually an art. It's more like a very creative thing. It's an art of arranging your affair in a way that it will postponing your tax. And by employing the effective tax planning strategies, you can have more money in your bank account, okay? And you should not change your financial behavior solely to reduce tax. I do not want you to do that, okay? Just because you want to get a tax deduction and you're changing your financial behavior, it's just gonna make you backward. And the true effective tax planning strategies are those that permit you to do what you want while reducing tax bill along the way. So what I mean by that is like, yes, you get a tax deduction, but you're also increasing your wealth at the same time. So there's 3 important things that you need to do before the 30th of June, 2020. First of all, very important, you have to contact us if you want to get take advantage of this, like to do your tax planning, to be able to legally reduce your tax and, you know, give you more money in your pocket. And second thing is very important is that for those that you have trust, you need to reply back to our email when we send it to you. Is like, you have to decide the 2020 trust distribution, that what we're going to distribute, and we will guide you and we will help you with that. But you must sign this trust distribution resolution before 30th of June in order to avoid paying that 47% tax on your profit. Okay, this is a very important part. And the third, this is still second important, is that if you have a company, then I'm sure during the year, you probably draw some cash out from your company. Then we have to be careful about Division 7A problem. It's like, you can only draw the money out from the company by way of wages, director's fee, bonus, or frank or dividends. But if you don't have the loan statement, then the money that you draw out can be treated as an unfranked dividend. If that's the case, then you're going to pay tax of 47%. So this is a very important, and we have solutions to help you to fix up this problem. So we can help you with that. So not to worry, okay? There's 3. Okay, number 3 is like, for those that in business, you better make sure that, you know, your STP is up to date, your PAYG payment thing is up to date, and your super employee you're paying before the 30th of June, and so forth. So this is more for I'll like a reminder to you. So have you any questions before I sum up? Okay, I can't see any question coming through. That means that I'm pretty good in explaining things. So, you know, I really believe that if you meet with us to do this tax planning meeting, you're really going to save your tax. And I don't know how many times, like maybe 4 or 5 times of the fee that you're paying us. Because what we're charging fee for doing this tax planning, and for individual, we're charging like from $500 plus GST. But what I can ensure you is like whatever the money that you pay us, you're going to get 4 or 5 times more from that. And not only that, it's also tax deduction for you as well. So what I want to say here is that if you really want to save your tax, then you better make a booking, because I'm very busy for the next few weeks. And what I can do is that whoever book first, I will have that meeting with that person first, like first in, first serve. Okay. And I can almost guarantee you that if I do the tax planning strategies with you, that you definitely will save a lot of tax. And what I want you to know is like 3 things I want to say is like, I am really good in saving tax for you, because I have been in this industry for so long. Not only that, I have been helping a lot of people saving a lot of tax legally. And I know that a lot of people want me to do it for them. So I still have time to help you. So again, Maris will send you the link. Hopefully she can put it in the chat box, the link that you can make an appointment to talk to me about this tax planning. And then I can work out the planning strategies to help you to save tax. And what I can really guarantee you is, oh, hang on, what happened? Sorry. I'm just going to go back to the last one. Can you see my screen? Okay. What I want to say to you is like, the price that you pay us to do this tax planning, if at the end of the meeting, like if I can't save you tax at least double this, right? That means like, let's say if you pay a 500, at least if you can't get tax saving of at least 1,000 or more, then the meeting that you have with me will be free. So what I mean is like, I will not charge you if I can't save you any tax, at least 2 or 3 times of the amount that you pay us the fee. So I think, I mean, this offer, like the offer that I'm giving to you is like, you can't lose. So what I want you to do is the next step, that what I want you to do is that I want you to booking to with me now, and then I can help you to save as much tax as possible before this financial year end. Okay. Can you all see my screen okay, or am I just lost you? Yes? Okay, great. Okay, fantastic. Thank you. So so if you have any questions that you want to ask me, please ask. Or if you want to talk to me privately, please book a meeting with me, and then I can go through your personal situations and help you out to save as much tax as possible before this 30th of June, to get as much money back as possible, so you can do whatever the things that you want to do. Okay. Thank you so much. If you don't have any question, I finished my presentations, and I really want to tell you that this is urgent, and it means like, it's money for you. So please don't put it off. Take action now. Okay. Thanks. And bye for now. And contact me if you have any queries and all that. I hope this is useful. Thanks. Bye.